95% of active investors lose money. And it's not for lack of intelligence, it's for lack of character. Those are the words of Charlie Munger, the man who, together with Warren Buffett, built one of the world's greatest fortunes starting from practically nothing. Today, I'm going to show you why Munger says that active trading is like heroin, why he calls Bitcoin disgusting dementia, and why he states that the only way to lose money in stocks is by being stupid. This isn't another investment advice video. It's a brutal dissection of why most people systematically fail at investing, narrated by the sharpest mind on Wall Street. If you're one of those looking to get rich quick, you can close this video now. Munger has a very clear message for you. It's really stupid. But if you want to understand the difference between investing and speculating, between creating wealth and destroying it, stay. Because what you're about to hear probably goes against everything you've been taught about money.
Section 1. The brutal reality. The problem isn't intellect. Charlie Munger has lived 99 years and has seen more bubbles, crises, and speculative manias than any other living investor, and his diagnosis is devastating. People who invest have exactly the wrong approach. What is that wrong approach? Munger explains it this way. 90% of people who buy stocks think of them as something they hope will go up next week. They don't see stocks as a stake in a business. And here's the first brutal truth. The problem isn't that you're not smart enough. Munger is categorical. Success doesn't require an IQ of 170. 120 is enough. What's needed is the right orientation. What does right orientation mean? Warren Buffett, Munger's partner for over 50 years, summarizes it perfectly. I look for 3 qualities in people: intelligence, energy, and integrity. But without integrity, the first 2 will kill you. If someone doesn't have integrity, it's better if they're lazy and dumb. This is the first devastating lesson. Investors fail due to character problems, not capacity issues. Munger sees it as a moral problem. Rationality, he says, is a moral duty, but most people prefer comforting illusions to harsh reality. Section 2. Trading is heroin, the condemnation of speculation. Now, we come to one of Munger's most brutal criticisms. When asked about teaching active trading to young people, his response was devastating. If you take the modern world, where people are trying to teach you to come in and trade actively in stocks, well, I regard that as approximately equivalent to trying to induce a bunch of young people to start off on heroin. It's really stupid. Why such an extreme comparison? Because Munger understands something most don't see: the addictive nature of speculation. People love to gamble, and the problem is it's like taking heroin. A certain percentage of people, when they start, just go overboard. It's that addictive. It's absolutely crazy. It's become delusional. Munger explains there are 2 types of people in the market: investors, disciplined, hardworking, and thoughtful when buying assets, and speculators, seeking nothing but quick profit without caring about intrinsic value. And the problem, according to Munger, is that when these 2 categories can trade together, it's something absolutely insane for the country. It's ridiculously crazy. What's the practical difference? An investor asks, what is this business really worth, and can I buy it for less? A speculator asks, will this go up tomorrow so I can sell it for a profit? Section 3. The get-rich-quick delusion. Bitcoin and the greater fool theory. Munger reserves his fiercest criticism for what he considers the culmination of modern speculation: cryptocurrencies. Bitcoin and other cryptocurrencies are dementia. It's disgusting and contrary to the interests of civilization. Why such severe condemnation? Because Munger sees in cryptocurrencies the essence of what he calls the greater fool theory. What is the greater fool theory? It's when you buy something not because it produces value, but because you hope that a bigger fool than you will buy it from you at a higher price. As Bill Gates explains, cryptocurrencies are 100% based on some kind of greater fool theory. Munger is brutally clear. Speculation with non-productive assets is simply counting on finding a bigger fool. Bitcoin doesn't produce anything by itself. Compare this to a Coca-Cola stock which produces billions in earnings every year, or a property that generates rent. Bitcoin, according to Munger, is essentially useless. And what about those selling courses promising easy wealth? Munger has a devastating logic test. It makes no sense that someone who found a way to earn 300% annually is selling books on the internet. If you could really do that, you'd be too busy getting rich to sell courses. Section 4. Cognitive biases. How your brain conspires against you. Munger has identified 24 cognitive biases that destroy investors, but there are some particularly lethal ones. 1. Overconfidence bias. A careful study in Sweden showed that 90% of automobile drivers considered themselves above average. And people who sell something successfully, as investment advisors do, make Swedish drivers sound like depressives. 2. Authority-following tendency. People follow experts without questioning. Everywhere there's a big commission, there's a high probability of a scam. 3. Social proof. Following the herd. Imitating the herd invites regression to the mean. People buy because everyone is buying. 4. Extreme loss aversion. Losing something triggers a stronger reaction than gaining the same amount. That's why people cling to losing investments. Munger's solution. The big trick in life is getting your own brain not to deceive you. Rationality is a moral duty. Section 5. The circle of competence. Know your limits. One of Munger's most important teachings is the concept of the circle of competence. If you have competence, you know pretty well its limits. Asking whether you're past the limit is answering yourself. Munger divides investments into 3 categories. Yes, I understand this business perfectly. No, not for me. Too hard to understand. Pass. You don't have to be brilliant, only a little bit wiser than the other guys on average for a long time. What's the most common mistake? Investing outside your circle of competence. Serious mistakes, or mistakes of omission, occur when people don't invest in what they know or when they try to predict macroeconomics, interest rates, recessions. Munger's philosophy is simple. We have a passion for keeping things simple. If something is too hard, we move on to something else. What could be more simple than that? Section 6. The right path. Graham, Buffett, and Munger principles. Now that we've seen all the mistakes, what's the right path? Number 1. Graham's principle. A stock is a piece of business. Benjamin Graham, Buffett's mentor, taught that a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its stock price. Number 2. Mr. Market, your manic depressive partner. Graham created the Mr. Market metaphor. Imagine that in some private business, you own a small share. One of your partners, named Mr. Market, is very helpful. Every day he tells you what he thinks your interest is worth. Sometimes his idea of value appears plausible. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes to you seems a little absurd. The key: the market is there to serve you, not to instruct you. Number 3. The margin of safety. When you build a bridge, you insist it can carry 30,000 pounds but you only drive 10,000-pound trucks across it. The same principle works in investing. Warren Buffett. Buy for 50 cents what's worth $1. Number 4, patience and long-term perspective. The big money is not in the buying and selling, but in the owning. Charlie Munger. Buffett's best investments took 5, 6, or 7 years to bear real fruit, not months.
Munger's final message. After 99 years of life and over 70 years of investing, what is Charlie Munger's final message? If you want to invest like the professionals do, you must stop looking for the next big hit. Success lies in discipline, patience, and the fundamental principle, the margin of safety. Failure in investing is not a lack of money, it's a moral and behavioral choice. As one of Munger's partners said, if crooks only knew how much money could be made by being honest, they would all behave differently. And Munger adds, take the high road, it's never crowded. The final question isn't whether you can afford to invest correctly. The question is whether you can afford not to. All I want to know is where I'm going to die, so I never go there. Charlie Munger. Don't go where the speculators go. Don't follow the crowd. Don't seek easy wealth. Invest as if your financial life depended on it, because it does.